we're going to be talking about growth versus value stocks and how to find income either through growth or through buying value companies. So, if you're looking for growth, if you're looking for growth, growth stocks are companies that are expected to grow at a faster rate than the overall market. And basically, as they begin to achieve this, right, because they have a strategy, as they begin to achieve this strategy, what they do is they reinvest their profits back into the business to keep fueling more expansion or keep fueling more growth. Now, on the other hand, value stocks are companies that are undervalued by the market and they have the potential to grow, right? They have the potential to have significant price appreciation, right? Now, are they going to grow at the same rate of a growth stock? Most likely not. But these are companies that are not the companies that the average person would buy. So the majority of people in the stock market, they're going to buy the explosive growth companies or the companies that most people see on TV. So as you already know that young stock investors, they want to make a lot of money. The average stock investor who is new to the stock market game, they want to make a lot of money. So they're going to hear about the Apples. They're going to hear about the Nvidias. They're going to hear about the Teslas because those are huge companies, right? They have huge growth profit margins and they're doing huge expansion in revenue. So they're going to be on TV talked about a lot. But there are other companies in the market that a lot of people don't really get to look at. Companies that have been around for years and decades that are not what the word that I say is not as sexy as the growth companies. But because there are established companies, because there are big companies, they can be even companies that are worth hundreds of billions of dollars in market cap. They provide dividends. Now, we told you that dividends before is like a sweetener that a company will give you to hold the stock because you are owner. And dividends are a stream of income. So I know as a young investor, sometimes you may look at these high explosive growth companies and say, well, I'd rather invest in a Tesla because I know maybe in 2 years Tesla may give me 100%. But don't underestimate value companies that are giving you consistent dividends because they're going to be paying you a check quarterly, and that could be compounded, growing, steady income coming into your portfolio account every year. And so you never want to uh, underestimate the power of an income strategy. And a good investor makes sure that they have a growth and value strategy. So we told you that growth stocks are companies that are expected to grow revenue and earnings faster than the market. Remember, we told you that the market is 500 largest companies in America, right? So growth stocks are going to have a market appreciation higher than that. So if the market, let's say, goes up 10% a year, then a growth stock like an Apple or a Tesla, it is expected to go up 20% or 30% or 40%. We also said with growth stocks that companies reinvest the profits, right? So the company might say, okay, we made $100 billion this year of profit. Instead of getting a portion of that to you in a dividend as the investor, because you own the stock, what they will do is they will invest in the company's infrastructure. They might invest in the technology of the company. They might invest by hiring more employees. They might invest by building a new strategy for more products. So this is all what a company does when they want to grow. They might invest in research and development or build a data center or a warehouse in China so they can be more competitive in their industry. And so if you want to look at like the sectors and stocks that are growing rapidly, basically you would see like tech stocks, biotech, AI are the narratives right now that are stocks that are growing very, very rapidly, right? So think about growth stocks being tomorrow's potential. Think about growth stocks being tomorrow's potential. So we can see companies like Tesla, companies like Amazon, companies like Nvidia. You're going to see huge market appreciation and huge potential for these companies to grow at exponential rates, even greater, sometimes two, three, or four times greater than the S&P 500 or what the market is doing. Okay, so Peter Lynch says growth stocks are about tomorrow potential. So here's a chart that talks a little bit about growth stocks. So with growth stocks, the company is expected to grow revenue and earnings faster than the market average. We say that these companies have the potential to outperform the overall market in terms of financial growth. And so if you're looking to buy companies that you want to perform tremendously better than the overall market, you just have to keep one thing in mind that these companies are going to be more volatile, right, than the overall market, which means you're going to see a lot of up and down price increases, price decreases. You're going to see a lot of price fluctuations happening in these growth stocks. Now, how are these companies going to outperform? We told you it's usually driven by innovative products or services, or they have a special type of business model that is better than their competitors. So the companies often reinvest their profits back into the company. We said growth companies prioritize reinvesting their profits back into their business. And what that does is it creates expansion, it creates development, it creates greater movement in the company rather than taking a large portion of the profits and redistributing back to the investors through dividends. Because what growth companies want to achieve is this: they know that if they can grow the company at an exponential rate, then you won't need a dividend because your growth is going to do better than them giving you a dividend. So if you make 50% of a stock on the stock, that explosive growth is going to be better than you making 10% on the stock and you receiving a 6 or 5% dividend because that's only 15% for the year. And a growth stock can achieve 30, 40, 50% for the year. So you're making 25, 30, 40% greater with a growth stock than with investing in a value stock. Now, the question that people always ask me is like, which strategy is better? And we're going to talk a little bit about that in a second, because that's a question that people always ask me. They're like, okay, which strategy is better? Which strategy? But I want to know, should I invest in growth stocks? Should I have more growth stocks in my portfolio? Should I have more income stocks in my portfolio? Well, to answer this question a little bit, you have to think about a lot of things. One thing we talked about is risk tolerance. There's some people when they invest, they can't take a lot of risk. There's some people when they invest, they can take a lot of risk. So that's one of the things for those who are watching on YouTube. That's one of the things you're going to have to really understand is that what is your risk tolerance? Because if you have a a tremendous risk tolerance, then a growth stock option might be something that you want to invest in. You also have to take in consideration what the economy is doing, right? Because if the economy, right, the macroeconomic events is not performing well, we told you on last week, if interest rates are high, right, then that's usually a bad macroeconomic barometer for stocks, right? Because people usually invest in the stock market or high risk assets when there's a low interest rate environment. So you're going to see value stocks or income stocks are going to perform better. So right now you're seeing in this environment, people are moving to what we call quality or value stocks, stocks like Coca-Cola, stocks like uh, Johnson and Johnson, United Healthcare. Why? Because these, we talked a little bit again on non-cyclicals and cyclical stocks. These companies, even though they are not the companies that people are watching on TV all the time, like Apple, Facebook, Nvidia, these companies are going to consistently make profit. Now you say, why? Because these companies are necessity based businesses. People have to eat. People have to get health care. So these are people have to go to the bank, right, with financial transactions. So these are opportunities in value that even though you won't make a tremendous amount of money compared to growth, it's like insurance. It protects you during the downturn. I think I have my brother Darius online. He just got in. Darius, as you're looking at this, is there anything that you want to say about this? A little bit about growth stocks and the difference between growth stocks and value stocks. Is there anything you want to share with that?
Hey, how's it going?
Everything's going good, my
Yeah,
brother. How you doing?
I just wanted to add, if you didn't touch on it already, growth stocks are usually a little bit more, um, I would say, companies that have a little bit more publicity of opportunity to overall grow your wealth. Is some of the ones that's been like over the last, I would say, 5 years has been Tesla. Tesla has been looked at like the growth stock. Um, it had stock split a couple times over that time frame. I remember I bought into Tesla around May 2020,
Hmm.
so I was able to get it before it stock split twice. So I was able to get in. I think before the stock split price, it was around. Hmm, I can't think of the price right now, but it was around under $100 at the time. But since the stock split twice after that, that initial um, one stock was around about, I would say, 20 shares of stocks after that. So it was a way for me to really grow my wealth at the time. I had invested a good amount into it, but in about 6 months, it had tripled my money, tripled my investment because of that. Um, so we're talking about a plus 300% return in the case of about 6 months, and that's one case of a growth stock. But you're looking to outpace the normal, standard rate of the 12 to 15% growth, like the S&P usually does. But that's why I kind of want to add.
Oh yeah, absolutely, and that's the thing. So, like Darius said, is the growth stocks it offers huge potential, right? Like you said, huge potential for capital appreciation, and this is why we've been really dealing with many of you in the group about investing in growth stocks, is because what you have is time. Even if the growth stocks you buy go down by 20 or 30%, if you stay in the market, you're going to make considerably more than you've made. Even with some of the ETFs we have you in that may have went down 8, 9, 10%. But by the end of the year, you're going to see that with growth stocks, they're going to continue to make money, and you're going to be able to earn 50, 60, 70, even 100% over your money within 12, 24, 36 month time span. So, yes, it comes with higher risk. Yes, it comes with volatility. It means there's going to be price fluctuations over time. But the more you are in the game, the more you stay invested, you're going to limit the risk dramatically. You're going to limit the volatility. So you have to think of stocks as a mountain. Over the short time, you're going to see the mountain go up. You're going to see it go down. You're going to see all these different things happening in the market, going up, down, up, down, up, down. But over the long term, you're going to see that climbing up the mountain is continuous. And so just make sure that you understand some growth narratives of growth companies are early growth companies, which means they're just starting. That could be a tremendous risk because sometimes we don't have a gauge of how the company makes money, especially in this time with so much technology that's coming out and AI coming out with in the cybersecurity and the data center space. A lot of people traditionally don't know how these companies, even though they see the numbers, the revenue numbers, see that they're profitable, they just don't know how the company is making money. So that's a little bit of risk too. So you have to research these companies, and you have to really evaluate and understand the business core business model, and understand how the business makes money, because that's a big thing for investors. How does a business makes money for the investor? So another thing I want to talk about is value stocks. So value stocks is basically companies that are trading under their intrinsic value, right? And that's based on their earnings. Sometimes just because markets are efficient, that we told you that don't mean the investors or the buyer of the underlying stocks are rational. And because of that, what can happen is that people can put all that capital in these growth stocks and these growth narratives. And sometimes there's a company that's trading and performing very well, right? This could be a mature company, right, that has consistent profits, but it's not a company that people really care about. One of the companies that I could talk about is like I forgot, I think it's Door, the tractor company. That's a company that people would say, well, I don't really want to invest in Door because what does this company do? And people are always like, well, or another one like Tractor Supply is a company that, Home Depot is another company, right? These are companies that are huge companies, hundreds of billions of dollars, mature companies, steady profits. They're paying you dividends, the Johnson and Johnsons, the Coca-Colas, the Bank of Americas. And they might not have assistant growth, explosive growth. I mean to say consistent, explosive growth. But these companies are going to get it done year over year. And these companies are going to protect you in insurance in an economic downturn. So, there's a couple of investment value companies that I brought during the pandemic. One was Intermediate Public Group, IPG. They deal with digital strategies for magazines and advertisement. Now, the average investor really don't know about that company, but they have a consistent 3, 4, 5% dividend. And I was able to buy that stock probably at $19 when it was worth probably the intrinsic value was like $28, $29. And I invested in that stock until it went up to $37. So investing in value stocks gives you an opportunity as an investor to invest in undervalued companies with the potential for long-term growth and dividend income. The company paying you as an investor to hold a stock until the strategy for long-term growth pays off. And Darius, I want you to hop in here and anything that you would like to share about this, anything that from your expertise that you would like to tell everybody in the group, definitely want you to get in and talk a little bit about this.
Yes, when it comes to value stocks, these are these are mature companies that um, that the market, has placed a value on, that has been for a long time understood as a stock that will provide value to your portfolio. Like you said, sometimes they're dividend payers. Basically they make so much money and to attract people, just because the people may not know about them. They'll pay a dividend to attract more people to buy into their stock. Like for the example that you used. But some people just don't understand because if a company is not marketed, they might not have no interest in buying it. But some of these value stocks may not be, the shiny object that you focus on, but it can definitely pay out if you have the right amount of investment and dividend stocks are always a good pick to add to your portfolio to add that extra income that can be reinvested in that same stock or into something else. And then when you grow your portfolio, some people tend to live off their dividends. Stuff. That's all
Just
I
like
have.
that, yeah, yeah. I'm sorry. You want to finish the statement?
I don't know, Vaughn. That was all I had.
Okay. Like Darius saying, I got an analogy as he was saying that because we're a team. Think of a growth stock like a sports car. Like he was talking about a shiny object. What does a sports car do? They're fast, they're flashy, and they're built to go far quickly. And that's like a growth stock. The growth stocks, everybody know about them. They're going to get all the media attention. You're going to see that, you might invest in a company and in 1 month it goes up 30%. So people like that. But they often don't pay dividends, right? So they're fast, but and they can go fast, but it comes with a lot of maintenance, right? A fast car, like I have a BMW, comes with a lot of maintenance, and that's what a growth stock comes with a lot of maintenance. You have to watch it, right? Because if you just want to make money in the short term, it might go up 40%, but it might go down another 20, 30%. Now, in the long term, of course, you're going to see it go up exponentially. But in the short term, you might see these, we talked about the volatility, these fluctuations, right? Because the company is investing everything to make sure the company grows faster. Now, the value stocks are not like a sports car. Value stocks are like a pickup truck, right? They're steady, they're reliable, they're built to carry you in the long term with income. So every quarter, it's not sexy, but hey, I'm gonna get a check every quarter off of dividends, right? They're not gonna move fast like growth stocks, but they're gonna pay me regularly. And you need that strategy because you want to be paid regularly, right? And Darius said, there's times I use my dividend payments for, phone bills. Sometimes I use dividend payments for the year for vacation. Sometimes I use dividend payments for all kind of different things. And they don't have to come out of my principal or my pocket, from my regular income from my businesses. So, you know, dividend income is like insurance. It protects you. It builds capital appreciation and it's something that opens the door to really pay you no matter what's going on in the economy. And you want a strategy like that because sometimes growth stocks can be down for a month, 2 months, 3 months, 4 months. But with value stocks, you're gonna always get those dividends, rain, sleet, snow, and shine. There's an ETF called the Dividend Aristocrats, where some of these companies have paid dividends for 50, 60, 70 years, no matter the macroeconomic environment, no matter a Great Depression, no matter a recession. no matter what happened in the macroeconomic environment, the companies were still able to pay dividends to the investors. So that's why um, value stocks are really important. Right, I want to skip this one and go a little bit to the role of dividends. So dividends is basically profit share with shareholders, right? Dividends represent a portion of a company's profits and that are given to the shareholders, right? So let's just say the company makes 50% and they say, you know what, out of that 50% of profits, we're going to give 5% back to the shareholder, right? Because we know that that's going to keep the shareholder invested as they see that we appreciate the shareholder because they own our stock. We're going to, as a sweetener, give the shareholder some profits, some extra profits, so they'll be able to stay invested with our stock, keep their principal in our stock. So, I told you that dividends can be paid quarterly, right? But depending on the structure, dividends can also be paid monthly, right? So there are some exchange trade funds. We talked about ETFs, which gives you exposure to different sectors of businesses. They can be paid monthly. Like I have one uh ETF. It's called QYLD. It's paid 13% per year, and those dividends, those distributions are paid monthly, right? The average stock dividend is paid quarterly, and then that could be short-term and long-term capital gains that can be paid annually. So at the end of the year, sometimes in December, depending on the type of asset that you're in, type of asset, whether it's a mutual fund or exchange trade fund, they can give you one big check at the end of the year, which would generate regular income for you as the investor, right? So dividends help you. We went over that. It can help you in sideways markets, right? Dividends will help your investment grow in your account, even if the markets are not experiencing huge upside returns. You're still going to get your dividends. So, like right now in our environment, as we're trying to process tariffs, as we're trying to process an economy with high interest rates, as we're trying to process how corporations are going to be affected by tariffs, then you will have companies who have dividends that they're paying their shareholders. Where as all these things are being figured out in the real time, you're still getting paid income monthly, quarterly, or annually. So that's why dividends are important, right? And so, with certain companies, you understand that when you're investing in stock, that there's two different type of strategies with your dividends. You can reinvest your dividend check. A lot of my stocks are in drip, and drip is basically to compound long-term wealth. You can take your dividend and reinvest it back into the stock. Now, for some of my stocks, for some of my ETFs, for some of my mutual funds, I don't have drip, right? I cancel drip because I might use it to pay for something. But for some of my stocks and ETFs and mutual funds, I do have drip because it gives me the ability to reinvest those dividends, that income back into that stock, and it gives you the ability to buy stock without actually have to take money out of your income, have to take money from your job. You can reinvest in the company by the money you've already made in the stock. So dividends, it offers a tremendous way for investors to generate a lot of income and build long-term wealth, and basically, create a well diversified investment portfolio. And Darius, if there's anything you want to share or add to that, or anything, your take on this, or if you want to give the people your strategy of how you buy dividend stock companies, whatever you want to say or add to this, you can say that at this time.
Yeah, I would say the dividends is a perfect strategy. Once you move your uh, portfolio to six figures to get to that seven figures, and afterwards just get paid quarterly, monthly, yearly with dividends, because that takes all the worry out of investing. Imagine if you had a seven figure portfolio, and it's going to and you have in the ETF, dividend ETF, the ETF is going to go up, still 10, maybe 10% a year, but it's still going to pay you out, imagine, 5% yearly so that's still like $50,000 a year that is coming directly to you via dividends. That's money that you can live off. So when you have a long term mindset with your portfolio, you need to know the next steps after you make a six-figure portfolio, a seven-figure portfolio, because you need to know these strategies, and these strategies are available to help you maintain wealth, but also still grow your wealth, and make investing very streamlined for you and easy. So you can just live off your investment portfolio. You won't have to be. A lot of people retire and their income isn't there anymore. You can offset that with your dividend portfolio. That's how I have to add.
Well, and just like Darius said, we want to, the growth strategy is going to get you to the million faster. But the value faster, the value strategy, once you get your million, you'll be able to capital appreciate that, right? Basically protect, have insurance. Let's just say you got, like Darius said, let's say you have $1 million and you're investing in QYLD. QYLD right now is like 12%, 13%, right? And dividends, right? Consistent dividends. It's something that I've been in since 2020, right? It's been paying me consistent dividends of 12% over the last 5 years, right? So if you invest in that and you got $1 million, you're making $130,000 a year just off of dividend income. So that's a salary. So now you don't got to worry about a job. You don't got to worry about a 401k.
That's
You
a
don't got
real
to worry
good
about,
salary.
yeah, yeah, yeah. It's a salary that you got, and now that's extra money that's you're making on top of your money. And you can use that because we know now, some of you who are going to be watching, we know everybody's not in Louisiana, but most of the people who are on, this broadcast live in Louisiana. You already know $130,000 in Louisiana goes a long way. You can go buy some investment property. You can go take a couple nights vacations. You can take care of pretty much all of your expenses. I have my dad in QILD for multiple six figures, and the check that he gets um, every month is four figures. That's thousands of dollars. I won't say too much about it, but every month that's thousands of dollars that he gets without rain, sleet, snow, or shine. He's getting those thousands of dollars every month. He's been getting it consistently. I'm getting close to about uh, four figures. I'm almost there. I'm going to be there probably in the next 2 years, four figures every single month getting paid. So you sitting down and you can relax it. Okay, so what we're gonna do is we're gonna shift gears. After this, I'm about to cancel the recording on this because this is gonna be a separate recording just for our YouTube for growth stocks. So we're about to stop that real quickly.